When it comes to the active management space, I want to talk about what we're seeing in the market environment. That's important whether we're talking about any sort of financial investment. So first and foremost, can you tell me your perspective on the current investment climate?
So we've had a reminder in the last couple quarters that the market is a little bit more volatile than historically. And so it's happened partly because there's a slowing in the economy in the world. So China's bumpy, Europe is weak and maybe in a recession, and then the United States industrial economy is on the soft side. And then on top of that, we had a Fed that was raising rates last year and then now is in neutral and maybe about to go in lower rates. We had an inverted yield curve, which is often a signal of a year or a year and a half in advance that you could have a recession. And then you have the trade frictions. So we have a president who has discovered that tariffs are a weapon that he can use to go and get other countries to go and hopefully do what he wants. And so that's caused a flurry of pressure on the stock market. So we've had both up and down. And then also in the backdrop is we're 10 years into an economic recovery. So we may be due for a recession just from old age. And we also have a stock market that, at least on Warren Buffett's measure, is the second most expensive it's ever been.
Mike, how does an equity manager, especially an active equity manager, assess short-term risks? I know that you highlighted current trade tensions and how you're watching that, but on a regular basis, how do you assess these risks?
So when we see something that's short-term, that's usually just something that you trade against. So for example, when we saw the Mexican tariff announcement, we really felt that it would be so disruptive to the US economy that it was more likely to be a bargaining position rather than something that was actually going to get implemented. And so in that type of situation, if the market goes down, that's an opportunity to buy. If the market goes up, then it's an opportunity to sell. And we look at sentiment indicators to go and help and guide us on that. And in particular, we look at the breadth of the market advance or the narrowness. And so, for example, when the Mexican news came out, the market came under pressure, and then there was a day when 80% of the stocks in the market were down. And that was an indication to us that there was kind of liquidation selling, and that was the point where we started to go and buy. Mm-hmm. And we identified some names that had come under a lot of pressure in the last couple of weeks that we thought there were opportunities in that we'd had on our buy list. So those are the names we added to.
What is your investment philosophy?
The appreciation portfolio is a large cap core product whose goal is to beat the market over a market cycle, but to do it with materially less risk. And when we think about risk, we think most of all about downside capture. And that would be, say the market's down 10% and we're down 8%, that would be an 80% capture, and that's what we look for. So we want to protect on the downside. If you look at the history of our portfolio, what you find is that when the market is up 13% in a year or less, we outperform. And only when the market is up an awful lot do we underperform. But over a cycle, we outperform by a little bit, and we do it with a lot less risk. Mm-hmm. We do it by owning large cap, high quality companies Warren Buffett would say have a moat around them. So strong balance sheets, strong management teams, high margins, and earnings that are very robust in a recession.
And Mike and Alex, we've set the stage for this discussion on active management, and you just mentioned the word risk. So generally, can you tell us how active management can be beneficial during especially volatile periods of time?
So a passive fund, when the market goes down, say 55%, as it did from the peak to the trough in 2007 to 2009, you're stuck. If you own a passive fund and it goes down 55%, you're down when the market's down. Our portfolio, because it owns the types of companies whose earnings continue to be steady or even grow in a recession. So let's say a company like PPG, which is a paint company. So volumes of paint don't grow an awful lot, they don't shrink an awful lot, but raw materials move around a lot. And so in a recession, the volumes go down a little bit, the raw materials go down a lot, and their earnings per share growth actually accelerates. And so PPG is a company that actually can go up even in a down market. And so we tend to own those types of companies that have very strong balance sheets. They're the last companies that people sell when they get nervous, and the first ones that they buy when they begin to get more committed to buying the market.
How can active managers protect on the downside during turbulent periods compared to risks that investors in passive strategies are exposed to?
So I made reference to PPG and the paint companies and companies that have sustainable earnings in a downturn. Another thing you want to watch out for are companies that need an awful lot of cash to feed their business model. So for example, I love Netflix. It's an amazing company, amazing business model, but they need $3.6 billion a year to go and feed the beast to develop the new content. And so when the market gets messy, they're very volatile. As an example, the market was down 19% in the fourth quarter. They were down 70. So it's a very volatile stock. So when you get to a point where you think that the market is going to be risky, and we're late in the investment cycle, we've had an inversion of the yield curve, now is the time to begin to be careful about your portfolio. Now is the time to batten down the hatches. And so a name like Netflix, that early on in economic recovery is something you probably do want to own because it's going to be a powerhouse, at this point is very dangerous and you want to avoid.
Mike, when it comes to the benefits of active management, what is the value of fundamental bottom-up research, and how does that guide active stock selection?
So the key with active management is to have company contact and to get an information edge. So I'll give another negative example, but in September of 2017, I met with GE. And so the bull case on GE at that time was that they were very depressed in earnings because their industrial business, their power business, was cyclically depressed. And the thesis was that over the next couple of years, that orders would pick up, margins would pick up, earnings per share would explode, and the stock was very cheap on that basis. So we met with the head of power, and what he told us actually was it wasn't a cyclical problem, it was a secular problem. That there was a major change in the technology, that the technology was moving to an area that was more commoditized, where GE had a weaker market position, and that the earnings weren't going to come back. Now, this is public information, but because we were meeting one-on-one with him, we were able to probe and to really understand the business, and that gave me the conviction that I needed to walk away from that stock, that the bull case was wrong. And so we sold it at a heck of a lot higher price than the stock is at right now. And so the key is, for us at least, that we're a very large company. We have $140 billion under management. We talk to companies all the time. Yesterday there was the announcement of the UTX Raytheon merger. We're decent-sized shareholders of both of those. We've had long relationships with the companies, and we had telephone conference calls with the chief managers of both companies in the last couple of days. And so we're able to go and get insights because we have contact with the management teams, and that helps us guide our investment decisions.
And I do want to move on to some of the market trends that we're seeing right now. Now, we can't deny where we are in terms of the cycle of the current U.S. economy. So, Mike, starting with you, what qualities do you look for in equities during the late stages of an economic cycle?
You want to own those large cap, high quality companies. They offer liquidity when people get nervous. Those are the last names that they sell, and if they have to sell them, they don't have to punish the stocks in order to get out of them. You want to own companies that have great balance sheets and defensible business models and sustain their earnings and cash flow in a downturn. So as I say, it's just the types of stocks that are in my portfolio.
What do you think has changed in terms of the landscape and what active managers need to pay attention to?
I think that the increasing use of passive, and the market has become much more efficient over my career. So when I started in the late 1980s, you could call up a pretty large cap company and you could get information that might be different and might give you an advantage. Nowadays, it's much, much harder. You have to work much harder for it. And so we do a lot of the same stuff that Alex does in terms of looking for big trends. So as an example, one of the things that's really helped the portfolio over the last 6 years is that we identified 6 years ago that there was going to be a massive expansion in the cloud business. And so we have had big positions in the public cloud vendors. Microsoft is the biggest name in the portfolio. And basically there's a massive shift going on in the way that software is developed. It used to be kind of big monolithic clobs that were difficult to debug, and it was easy to make errors and difficult to find errors. Now programs are more agile. They're easier to change. And then also the cloud offers by the second time sharing. And so if you're Netflix and you have a ton of demand at 7:30 in the evening and very little at 12 in the afternoon, you only have to pay for the resources when you use them rather than all the day. Mm-hmm. And so we look for big term trends, big time trends, and tend to own companies for a long period of time.
Mm-hmm. And we've been highlighting the tech sector, especially the disruptors, whether we're talking about Netflix or the gig economy, 5G or AI. But how do you make sense of a lot of the newcomers to the market? For example, someone who might not be part of the millennial generation, they might not know what Slack is, for example, or what they do. And when it comes to the gig economy, it's all about adoption and the generation you're talking to. For example, if you have someone who is in Gen X, they may know how to use Uber or any of the ride-sharing apps. But when it comes to factoring in how quickly these disruptors may grow or may not grow, how do you assess that landscape? What's your perspective on all of this?
We have awesome technology analysts, and so when we have a name like a Slacker, then we have people who are really up to speed on the technology, are able to go and make recommendations on it, and they have a lot of insights. Our analysts understand those nuances very, very well, and so they help guide us.
When it comes to lessons learned, when you look at your decades of experience, there may be people watching this masterclass right now, advisors looking for words of advice. So what would you say to them when it comes to your space? Are there any lessons learned that you would like to highlight?
Well, I'd say cycles don't repeat, but they do rhyme. And so there are things that you see every cycle over and over again, and things to watch for that can guide you in how you invest. I very much agree with Alex, though, that staying the course is a critical thing, and it's one of the features of my strategy that because we protect the downside, it enables you to hold when things get bad because you know that we're going to protect you. I would say right now the thing though that's rhyming is when you have the Fed, when the yield curve inverts, that is a real warning sign. We are late in the economic cycle. We do have to be careful right now. And so while you probably should be invested in the market, historically you get positive returns and good returns for the 14 or so months after an inversion, you also have to be more careful.
As an active manager, do you implement ESG considerations into your investment process, and how does that contribute to managing risk?
So ESG is one of the things that differentiates ClearBridge from other large cap managers. We integrate ESG intimately in our process. So each analyst who follows a company, every company that they follow, they have an ESG rating on it. So environmental, social, and governance. So they have 3 ratings, and they combine them together, and it's a rating that's anywhere from B, which is uninvestable. And so an example of something uninvestable would be, say, a defense company, so that makes weapons, or a tobacco company that sells an addictive, dangerous product, to a best-in-class company. So somebody like, say, a Costco, where while they're interested in making profits, they also take care of their employees really well, and they sell really good quality products. And so it's a company that makes you feel warm inside, and I think it's the root of their success. So ESG is integral to everything that we do, and even in our non-ESG portfolios, it colors what we do. We think of it as a quality aspect. If you look at the appreciation portfolio, on average, our ratings, so our ratings are B, A, AA, and AAA, where B is uninvestable and AAA is best in class. Our rating on average in appreciation is higher than AA. So we really like those companies that are good actors on an ESG standpoint.
Now, Mike, if you could tell me more about how ESG contributes to risk management.
So the ESG process forces you to go and focus on both the good and the bad things our companies are doing. As an ESG investor, when you're looking at those types of things, it brings them to the fore. And so you can't kind of just brush them aside. And so I think it helps risk control in our products because we're thinking about, is the company behaving well? We're more sensitive to those issues than we might otherwise be.
And Mike, moving on to what we're seeing right now, we are in the late stage of an economy. So how do you prepare for this in a market cycle?
So there are certain groups late in the investment cycle that are higher risk simply because you're late in the cycle. So an example would be banks. Banks have credit risk. When you have a recession, credit becomes a real problem. Customers go bankrupt, you have losses, and so banks tend to underperform. The other thing that happens late in the cycle, you have this inverted curve or you have a very shallow curve, and because banks tend to borrow short and lend long, their net interest margins are very low. So banks are a set of companies that tend to underperform, and you need to be careful to be underweight as you get late in the cycle. On the other hand, property casualty insurance companies, nobody buys a property casualty insurance policy because they want to. They buy it because they have to. So property casualty insurance sales in a recession are very, very stable. And also, they invest in bonds on the other side of their balance sheet. And when rates go down, which happens in a recession, then the value of that portfolio goes up. So they have gains. So you have, basically that's the ideal situation to own a property casualty insurance company. So there's certain types of groups that just thrive in a recession, and you want to make sure that you own those. And there's certain groups which have unusual risks, and you want to be careful about those.
And Mike, before we move away from ESG, we've seen an evolution in this space. And nowadays, if you look at financial media, whether it's print, online, or even broadcast television, we hear the term ESG a lot. So in this space, how do you think it's evolved and where do you see it going?
Well, I think that the way that it used to be was that people had screens. So I mentioned if you're a defense company, we can't own it. I think that this full integration and looking at companies and saying, okay, this company is good but could get better in this way. This company didn't used to engage with investors to talk about ESG issues, and now they do. And so companies are now sensitive to it, and it's starting to change the behavior of companies. So an example would be Walmart, which while it's because of its labor relations probably still is uninvestable, really focused on the environmental aspect, and so it has solar panels on its roofs. It's much more green. It's really changed the way that it's operated, and so ESG is a force for good, and we think that can make the world a better place.
And in today's masterclass, there has been a lot of reference or analogies to what we're seeing in active management. So I do want to take a look at the story Goldilocks and the Three Bears. Now, when we take a look at the Goldilocks economy, we always hear about, is it too hot or too cold? And we might forget about the actual story about a little girl who goes to the home of bears and tries porridge. Is it too hot? Is it too cold? And tries different chairs. But what do you see right now and when we're looking at the economy and the Federal Reserve? And do you think we are in a new Goldilocks economy?
I don't know that Goldilocks is the right analogy. I think that we have kind of a bifurcated economy right now where the industrial economy is on the ropes a bit. On the other hand, the consumer is doing very well. And I guess on balance, you probably bet on the consumer. The consumer has a job right now. They're seeing excellent real wage growth. And if there's one thing we know about US consumers is they love to spend money. And so that gives a stability to the US economy. I think it's one of the reasons why of the developed nations, it's been the fastest grower for decades and the leader. It's the strength in that consumer. And so I watched with a little bit of trepidation that employment number that we had for May. And so we need to watch that. So I think that's the critical thing. If the employment continues to be strong, then the economy will probably be okay, and we'll probably be able to go into bridge the issue that we have here with the industrial side of the economy. If we see further weakening on jobs, then I'm afraid we're in for a recession.
And now that we've gotten your perspective on what we're seeing in the economy and what you expect going forward, I do want to wrap up this discussion by talking about the future of active management. A lot has changed in this space, but what do you expect to see in the near term?
So I agree that the trend is certainly towards passive. On the other hand, we're already more than half of the market trading is passive trading. So there's a reductio ad absurdum, where if you get too much trading in passive, then the market can become wildly inefficient, because if everybody's trading passive, then when there are changes in the real value of companies, they're not being reflected because everybody's going and trading indexes. So there's going to come a point where it's actually going to create tremendous opportunities for active managers, and we're a lot closer to that now than we were, say, 10 years ago.
And of course, this is a masterclass, so I do want to get your closing remarks in terms of active management. If you had to tell a retail investor what active management is in a nutshell, how would you describe it?
And I agree. The key is to find a manager that has a repeatable process that offers you a different risk-reward combination than the market can give you. If you find the right manager, right active manager, you can do better than the market. And that's the key. If you own just the market, then your investment decision in the stock market is just an asset allocation decision of how much money do I own in the market. But there are better alternatives than that.
And since you mentioned some of the attributes of a good active manager, what would you say investors should be looking for when it comes to active management?
Most of all, consistency of process. And consistency of returns. And so each strategy, when it tells you that it's going to do something, it needs to do it. So if a strategy says it's going to protect on the downside, then look and see how it does in a quarter when the market's down a lot. If it says that it's going to outperform on the upside, then how does it do when the market goes up a lot? It needs to deliver on its promises.
And last but not least, since you mentioned consistency as well as performance, there's one word that gets thrown around a lot, and that's volatility. And volatility could be good or bad, but it's not always black and white. So how do you assess it, and how do you describe volatility?
Well, I say the volatility creates opportunities. So what you want to do is when you see volatility, you need to decide, is it real, is it short-term noise, or is it more significant? And then you also need to watch sentiment and to find out whether maybe the market's overdoing it. And so if you have an opportunity when things are going down and everybody seems to be really bad, so for example, a day when 90% of the stocks in the market are down, that's often a good time to go and buy stocks. Similarly, you want to watch when volatility to the upside, when everybody's too euphoric and 90% of the stocks are going up, maybe that's the time to go and take a little bit of money off the table. So volatility is opportunity.